Welcome to Money Moves, where today we're diving into the timeless wisdom of Peter Lynch, one of the most successful stock market investors of all time. In his book, One Up on Wall Street, Lynch shares invaluable insights that can empower even the most novice investors to achieve success in the market. Lynch's approach is uniquely practical, emphasizing the importance of personal knowledge and thorough research. From recognizing 10 baggers to understanding company categories, from ignoring market predictions to doing one's homework, each strategy is a key piece of Lynch's investment puzzle. These aren't just theories, but proven tactics that can provide you with maximum real-life advantage. Ready to unlock the secrets of one of the greatest investors of all time? Let's dive into Peter Lynch's 15 game-changing investment strategies. First up, invest in what you know. Lynch believes your greatest investment opportunities may come from your workplace or hobbies. Start by looking at industries you're familiar with or products you love. This insider's perspective can give you a significant edge in spotting winning investments. Ignore market predictions is Lynch's advice to investors constantly bombarded with market forecasts. Instead of trying to time the market, focus on finding quality companies. Remember, investing is a marathon, not a sprint. Make decisions based on company fundamentals, not market volatility. Ever heard of the 10 bagger or wondered about company categories? Well, you're in for a treat because we're about to delve into these two essential concepts that Peter Lynch swears by. First off, let's talk about the 10 bagger. This term might sound like something out of a baseball game, but in the investment world, it's a home run. A 10 bagger is an investment that multiplies in value 10 times over. Now, who wouldn't want that kind of return? Lynch believes that these golden opportunities are often right under our noses, hiding in our areas of interest or expertise. So, the next time you come across a small, promising company in your field, don't dismiss it right away. It could be your 10 bagger. Now let's move on to company categories. Lynch classifies companies into 6 categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each category has its unique characteristics and growth potential, and understanding these can help you set realistic expectations for your investments. For instance, slow growers are large, established companies that might not dazzle you with high growth rates, but they can provide steady returns and often pay dividends. On the other hand, fast growers are smaller, younger companies that are expanding at an above-average rate. They can offer substantial returns, but they also come with higher risk. Cyclicals are companies whose sales and profits rise and fall with the economic cycle. These require careful timing. Buy when business is bad but about to improve, and sell when it looks too good to continue. Turnarounds are no-growth businesses that have been discarded by investors but are now turning around. These can be very profitable, but are risky. Finally, asset plays are companies that hold something of value overlooked by the market, perhaps real estate, patents, or cash. Understanding these two concepts, the 10 bagger and company categories, can significantly enhance your investment strategies. They can help you identify potential winners and set appropriate expectations for your investments. So, the next time you're eyeing a company, remember to consider its category and whether it could be your 10 bagger. Do you know the importance of doing your homework before investing? This isn't about poring over textbooks, but rather about understanding the company you're considering investing in. Research is a cornerstone of Peter Lynch's investment philosophy. He encourages investors to delve deep into a company's financial health, competitive standing, and future growth prospects. This isn't about quick, surface-level analyses, but a thorough and comprehensive understanding of the company. Think about it this way. Would you buy a car without understanding its features, its mileage, or its maintenance history? Probably not. It's the same with investing. You're buying a piece of a business. You need to know what you're getting into. And this is where financial ratios come into play. Lynch emphasizes their importance in his investment strategies. Ratios like the price-to-earnings ratio or PE ratio, the debt-to-equity ratio, or the return on equity provide key insights into a company's financial health. They can tell you if a company is overvalued or undervalued, how much debt it carries, and how well it's using its resources to generate profits. However, Lynch cautions against relying solely on these ratios. They are tools, not crystal balls. They can guide you, but they can't predict the future. Always consider them in the context of the broader picture. For instance, a low PE ratio might seem attractive, but if the company operates in a declining industry or faces significant competitive threats, that low ratio might not be as promising as it first appears. Remember, informed decisions are successful decisions. Doing your homework, understanding financial ratios, and considering them within the broader context of the company's performance and industry trends can significantly improve your chances of making wise investment choices. This is the essence of Peter Lynch's advice. He encourages us to be curious, to be diligent, and to make decisions based on a deep understanding of our investments. Remember, informed decisions are successful decisions. How do dividends, the perfect stock, and long-term investment interplay in your investment strategy? Now that's a question worth pondering. Let's dive in. Dividends, for starters, are a delightful component of your investment strategy. They are payments made by corporations to their shareholders, often in the form of cash or additional shares. Companies that consistently pay dividends signal a certain level of financial health and a commitment to returning value to shareholders. They can offer a steady income stream, especially useful in volatile markets. But remember, while a good dividend history can indicate a company's stability, it's always vital to look at the bigger picture. Next, we venture into the realm of the elusive, perfect stock. According to Peter Lynch, this isn't always the one making headlines. Instead, it's often an under-the-radar company, operating in a niche market with minimal institutional interest. These stocks may not be the talk of the town, but they can offer substantial growth potential. They are often overlooked gems, waiting to be discovered. So, keep your eyes open, and you might just spot the perfect investment opportunity right under your nose. Now, let's talk about long-term investment. It's no secret that the stock market can be a roller coaster ride, with prices soaring one day and plummeting the next. But Lynch encourages us to keep our gaze fixed on the horizon. Short-term market fluctuations can be distracting, even misleading. The real value lies in a company's long-term prospects. So, invest in companies you believe in, ones that have a strong foundation and a promising future. Remember, investing is not about making a quick buck. It's about planting seeds and patiently nurturing them to grow over time. It's about understanding that the market's true reward lies not in the thrill of the chase, but in the satisfaction of reaping the fruits of your patience and foresight. So, how do dividends, the perfect stock, and long-term investment interplay in your investment strategy? They intertwine to create a balanced approach, one that can lead to a more profitable portfolio. These strategies can lead to a more balanced and profitable portfolio. Do you know when to hold, when to sell, and the role of a good company narrative? As we delve deeper into Peter Lynch's investing wisdom, these elements emerge as critical pillars of a winning strategy. Patience, in the realm of investing, is akin to a superpower. It's the ability to resist the urge to jump ship at the first sign of market turbulence or to cash in on a quick profit. Patience is about recognizing the value of time in the market, allowing your investments to grow and compound. It's like planting a seed and waiting for it to grow into a mighty tree. Lynch firmly believed that the market rewards the patient investor, the one who can ride out the storms and hold on to their investments through thick and thin. But patience should not be confused with complacency. Knowing when to sell is just as important as knowing when to buy. Lynch offers clear criteria for when it's time to part ways with a stock. If company fundamentals show signs of deterioration, or if the stock appears overvalued, it might be time to consider selling. It's all about striking a balance, holding on for long-term growth, yet being adaptable enough to pivot when the situation demands. Finally, Lynch highlights the importance of a compelling company story. Investing isn't just about numbers and charts, it's about businesses and their potential to grow, innovate, and disrupt. A powerful narrative can often be a strong indicator of a company's future success. It's about looking beyond the balance sheet to the story of that company, its vision, its mission, its potential to make a difference. This narrative can often provide insights into the company's growth trajectory and its potential to deliver returns. In essence, patience, knowing when to sell, and understanding the significance of a compelling company story are integral to a successful investment strategy. These strategies can be the game changer in your investment journey. How do you stay focused amidst market noise? And what's the bottom-up approach? Let's begin with avoiding market noise. In the age of information overload, it's easy to get swept away by the latest news or trends. But remember, as investors, our goal is not to react to every ripple in the market. Instead, we need to stay focused on the fundamental performance of our investments. It's about discerning signal from noise, separating the valuable insights from the distracting chatter. Now, let's talk about the bottom-up approach. Unlike the top-down method, which starts by assessing the macroeconomic environment, the bottom-up approach focuses on individual companies. It's about finding great businesses, regardless of the economic climate or market trends. This approach allows you to delve deep into a company's operations, financials, and competitive position, helping you make informed investment decisions based on the company's unique strengths and weaknesses. To implement Lynch's advice, start by assessing your interests and knowledge areas for potential investment opportunities. Conduct thorough research, focus on the long term, and remain patient and disciplined. Remember, the path to investment success is paved with informed decisions and a commitment to learning. If you found these insights from Peter Lynch helpful, don't forget to like, subscribe, and share your thoughts or experiences in the comments below. Join the Money Moves community as we continue to explore empowering investment strategies together. Stay tuned for more content designed to help you make smart, informed money moves.